Welcome back, Professor Morgan-Nance here. I hope you're having a great week so far. My hope is also that you have a strong understanding of the fundamentals of the accounting cycle, which we just covered in chapters 1 through 3, so that you can move into the remainder of the semester with confidence. Chapter 4 is where the true accounting begins. As we've discussed previously, please review the learning objectives on this slide and the next as you progress through the chapter to ensure you are on track. And you will also find them in your chapter checklist for success. In Chapter 4, you will begin to apply your knowledge of the accounting cycle to certain business scenarios. And specifically, you will acquire the skills to properly account for the purchase and the sale of inventory in a merchandising operation. I recognize that the majority of you are business students who are taking this course because it is a required part of your major. And my goal is to help all of you, accounting majors and business majors alike, become better business people. Merchandisers are a very large part of our economy. They range from your corner mini mart to the auto dealer to Target and beyond. In this chapter, you will learn how to identify and account not only for revenues and for margins, but amounts that reduce revenues and increase an account called cost of goods sold. The knowledge you gain by mastering this chapter is powerful. It will help you successfully interpret the financial statements of many businesses, whether very small or very large, throughout the remainder of your career. So far in this course, we've focused on accounting for service companies. Service companies sell their time to make a profit. Although the types of service businesses vary widely from lawyers to daycare providers, service companies have one thing in common. They do not sell inventory. The income statements then for a service company is very easy to prepare and read. Revenue minus expenses equals net income, and that's it. A merchandising, on the other hand, a merchandising company has different activities than those of a service company. Merchandise inventories is the stuff that a company buys and sells to make a profit. Merchandisers also vary in size and what they sell, but they are all in business to make a profit on something they buy for resale to their customers. And I'm sure you can think of many examples of retailers, right? Raley's, Safeway, Home Depot, Best Buy, CVS Drugstore, Goodyear Tire, Target. These companies all buy goods and products, mark it up, and resell it to you in order to make net income. You might even be a retailer yourself if you have a store on eBay, for example. Merchandisers have a new expense account called cost of goods sold. Now, the cost of goods sold, or in my shorthand, the COGS, C-O-G-S account in accounting shorthand, represents the cost of merchandise sold during the period to help earn revenue. For example, the cost of every TV Best Buy sells is included in the cost of goods sold account in the period in which the TV is sold. Cost of goods sold is presented as a separate expense item on an income statement. Also new is the presentation of the income statement for merchandisers. We call this a multi-step income statement because there are multiple levels of profit calculations. Notice on Z-Mart's income statement shown on this slide that net sales of $314,700 minus cost of goods sold of $400,000 equals gross profit of $84,300. Gross profit is another new term, but pay attention here. It is a formula. It's not an account. It is the amount a company has left after paying for the cost of its inventory to cover its operating expenses and contribute to net income. We record 2 journal entries every time we sell inventory, one to record the sale price times the quantity sold, and the second journal entry to record the cost of the inventory times the quantity sold. And we'll talk about this more in part 3 of this particular chapter. Merchandisers also have an asset account titled Merchandise Inventory. It's highlighted on this slide for Z-Mart. This account is used to account for the cost of inventory purchased before it is sold, and it's classified as a current asset on the classified balance sheet. It is usually displayed below accounts receivable because it is considered less liquid than accounts receivable. It must first be sold before cash can be received. It is, however, far more liquid than supplies or prepaid insurance, which don't have much of a cash value at all. A merchandising company's operating cycle is longer than that of a service company. It begins by purchasing merchandise, and it ends by collecting cash from selling merchandise. The length of an operating cycle differs across the different types of businesses. Department stores often have an operating cycle between 2 to 5 months, and really thankfully, the operating cycles for grocery merchants usually range from 2 to 8 weeks. You certainly wouldn't want to buy meat that was sitting around for 8 weeks, right? Yuck. So a grocer has more operating cycles in a year than, say, for example, a clothing or an electronics retailer. This exhibit in your textbook illustrates a very important concept that we will emphasize again in Chapter 5 when we talk about inventory costs. Please spend a little time on it now so you understand the concepts when we visit it again. As an example of how inventory systems work, let's think about Best Buy, the appliance and electronics store. Every January 1st, Best Buy will have a whole bunch of TVs in their warehouse that weren't sold during the Christmas holiday sales rush. And as a side note, merchandise inventory is a permanent account, so the same TVs would be in the ending inventory account on December 31st at the end of the prior year. Okay, so now we're talking about January the next year. In any case, the unsold TVs are accounted for as part of Best Buy's beginning of the year inventory and are recorded on the balance sheet as an asset. Now assume that during the month of January, Best Buy purchases more inventory, which it also records as an asset. The sum of the TV inventory it had on January 1st, plus the cost of the TVs it purchased during January, is equal to the total cost of TVs Best Buy could sell during the month. This amount is called the cost of merchandise available for sale. And again, it is a calculation rather than an actual account. Now, two things can happen to that TV inventory. The TVs can be sold, in which case the cost is transferred to the income statement account called cost of goods sold. Or the TVs can be still sitting in the warehouse at the end of January. If that's the case, the TVs become ending inventory again as of January 31st, and the costing cycle begins again the next month. Now, two methods of accounting for inventory are taught in this chapter. We teach the perpetual method and the periodic system of accounting for inventory. Periodic systems were used more commonly before computers were widely available. In the periodic system, a company accounts for inventory purchases and counts inventory on hand to determine ending inventory in its books. It backs into or calculates the amount of cost of goods sold once a month. It does not track the cost of each sale as it occurs, unlike what the perpetual inventory system does. We will focus on how to record inventory purchases and sales using the perpetual system because that is a system overwhelmingly used in business today. It not only provides more up-to-date information for managers about sales and margins, it also provides stronger internal controls because it allows a company to verify the inventory they're supposed to have on hand at any given time. Before we get very far into our discussion about merchandisers, I wanted to introduce to you the acid test ratio because it's quite similar to the current ratio which we discussed in Chapter 3. The acid test ratio is another common but more rigorous ratio that is used to determine the liquidity of a company. The ratio is calculated as quick assets divided by current liabilities. And this ratio determines if the company has enough liquid assets to pay current liabilities. Liquid meaning the same thing as quick in this case. So liquid is the key phrase. An asset is more liquid if it can be quickly converted into cash for its full value. Now, obviously, cash is the most liquid of assets. It is the very definition, right, of liquidity. Quick assets include cash, short-term investments. Think about investments that you could call your broker, like stock or bonds, to sell for you on a very, very short-term basis, and current receivables. Note that inventory, prepaid assets, and supplies are excluded from quick assets. Inventory isn't considered highly liquid because there are some significant costs associated with getting rid of it, okay, disposing and handling. If you need to sell it quickly, you have to mark it down, etc. Now, prepaid expenses and supplies are worth more to the company that owns them than anyone else. Your bank doesn't want them. So these things are not worth much in the case of liquidation of the company. A common rule of thumb then is for the acid test ratio to be at least 1.0, quick assets to be at least 1 times liabilities. But again, this can vary from industry to industry. So for a moment, please take a break and then move to the second part of our Chapter 4 video series. We're going to describe how to record the purchase of merchandise inventory for a merchandising company in the next section. See you in a few minutes.